Markets are now at 3-month highs. Let's bring in our floor show traders. They are here on whether you, the investor, should lower your stock exposure to maybe avoid collateral damage from what could be a war again, Cold War, trade war with China, or another violent night of riots around the country. Phil Flynn, I'll begin with you. You know, the risk factors are right in front of our faces here, and yet the market continues to enjoy a bull party. How worrisome or expected is something like that? And would you advise investors to shift around a bit?
You know, I think right now you want to stay calm, and I think that could be said for the entire country. I mean, we're going through an emotional thing right now with these protests and riots, and there's a lot of tension. But I believe in the American people, and I believe we can still come together and try to work through these problems. So I'm pretty optimistic, and I think the market is as well. We are seeing green shoots in the economy. We're seeing things start to get better, and hopefully as that economy starts to get better, some of the tensions that we've seen over the last few days will start to calm down a little bit, and we can focus. China, obviously a big problem, but China was going to be a problem anyway. We've been through the trade war situation. We've been through the volatility. At the end of the day, what we find out is the U.S. has a tendency to win these trade wars, and the stock market has overall benefited from the tension. So I think at the end of the day, I wouldn't, don't, sell out of everything right now. Wait to see how things play out. And I think you'll be rewarded at the end of the day, because I do think we're going to come together.
Tom, you're at the New York Stock Exchange. And again, we saw the markets make a 180, going from negative to positive on a piece of economic data that looked better than expected. But, as we look at the risk factors in the market, the pandemic is still here. There's a new outbreak in one region, the Rust Belt of China. And people are wondering what really is next when it comes to these protests and when the sun goes down. Although we just heard from our reporter, Christina Partsenevelis, that this morning in broad daylight, she saw looting right in front of her. You got businesses, many of which we know, whether it's Foot Locker or Citibank or CVS or Dwayne Reed, who have been Target, 200 stores have been affected. And it makes you wonder at the moment, what really will be a tipping point, if anything at all, for the markets? And perhaps it might be nothing. Maybe it is what Phil says. We believe in the spirit of America, and we are moving forward, not backward.
Yeah, well, Liz, the last time I was on, we talked about a rotation into cyclicals coming out of a recession. And as we've seen since then, the last couple of weeks, those groups have dramatically outperformed. So I think this is a short-term situation with the looting and the protesting that will work itself out over time. But what we're watching, and people are watching, is 95% of the S&P 500 stocks right now are above their 50-day moving average. And most people are saying that's overbought, except this has happened 5 times in the last 20 years after a 20+% correction in the stock market. And 100% of the time, it was the beginning of a multi-year rally, not the end. So there is cause for positivity, especially when you look at global fiscal stimulus is now 12% of global GDP. That's a tremendous amount of stimulus that's coming in, and I think that's going to continue to help these cyclicals. Like you saw in the last recession, the laggard value stocks actually outperformed. Lockheed Martin is up 10 times from the last recession, Home Depot, Boeing, United Healthcare, and Microsoft, all up 10x. They were laggard value stocks, and they led the way. And we're going to see these type of cyclicals lead the way moving forward.
Yeah, sure looks like recessions have been quite the buying opportunity. We remind everybody the May jobs report comes out Friday. We are expecting an unemployment rate to jump from 14% to 20%, possibly as high as 20%. Tom, Phil, we will check back in with you as the days go by. Thank you very much.